Most traders believe that if they can just win more, everything else will fall into place. They think consistency comes from being right more often, so they chase better entries, sharper timing, cleaner signals. They sit in front of charts trying to eliminate loss as if it is a flaw in their process. And without realizing it, they build their entire identity around avoiding being wrong. What they do not see is that this mindset quietly puts them in a constant state of tension. Every trade becomes a test, not of the system, but of themselves. And when the outcome does not match the expectation, the reaction is not neutral. It is personal. The moment a trade moves against them, something shifts internally. The body tightens. The breath becomes shallow. There is a subtle urgency that begins to build. It is not about the money yet. It is about the feeling of losing control. That feeling is what most people are trying to escape when they enter the market. But the market does not remove that feeling. It exposes it. What feels like a technical mistake is often just a nervous system reacting to uncertainty. The early exit is not about the chart. It is about discomfort. The hesitation is not about confirmation. It is about fear. The impulsive entry is not about opportunity. It is about relief. And this is where most traders get stuck. They keep trying to fix the surface. They adjust strategies, change time frames, search for new systems. But the internal response stays the same. So the behavior repeats. They are not trading the market. They are reacting to themselves. There is a quiet misunderstanding at the center of this. People think discipline means forcing themselves to act correctly. But real discipline is not force. It is stability. It is the ability to remain unchanged while uncertainty unfolds. And that stability cannot exist if loss is still seen as something to avoid. Because the moment loss becomes unacceptable, the mind starts negotiating. It starts searching for ways to escape. It looks for confirmation that is not there. It holds when it should exit. It exits when it should hold. Not because the trader lacks knowledge, but because the body is trying to reduce discomfort. Loss, in that state, feels like a threat. The body does not know the difference between financial risk and physical danger. When uncertainty increases, the same systems activate. Heart rate rises, attention narrows. Time feels compressed. The ability to think clearly starts to fade. In that state, there is no strategy. There is only reaction. This is why knowledge alone never translates into consistency, because knowledge exists in a calm state, but execution happens in a charged one. And if the trader has never learned how to remain stable inside that pressure, the knowledge becomes inaccessible. So the real work begins somewhere else. It begins with changing the relationship to loss, not as something to tolerate, not as something to recover from, but as something that is already accounted for, already accepted, already integrated into the process before the trade is even placed. When loss is no longer a surprise, it stops creating shock. When it stops creating shock, it stops triggering reaction. And when reaction fades, clarity has space to exist. This does not mean the feeling disappears. The body will still respond. There will still be moments of tension, hesitation, discomfort. But the difference is that those sensations are no longer interpreted as signals to act. They are just observed. And in that observation, something changes. The trader is no longer inside the emotion. They are aware of it. There is distance, and in that distance, there is choice. Most people never reach this point because they are still trying to feel confident before they act. They are waiting for certainty. But certainty does not exist in this environment, and waiting for it only delays the inevitable confrontation with discomfort. The shift happens when the trader stops asking if a trade will work and starts asking if they can remain stable regardless of the outcome. Because that is the only part that can actually be controlled. From there, the focus begins to move, away from results and toward behavior, away from winning and toward execution. The question is no longer whether the trade was profitable. The question is whether it was taken and managed without emotional interference. This is where consistency begins to form, not in the outcome, but in the process. And at first, This feels underwhelming. There is no rush, no sense of victory, no emotional high, just a quiet execution of a plan, a small position, a controlled response. A neutral exit. It does not feel like progress, but it is, because what is being built is not a better strategy. It is a more stable operator. And that changes everything over time. The trader who can remain calm while losing is not the one who avoids damage completely, but they are the one who avoids unnecessary damage. They do not compound mistakes. They do not escalate risk. They do not try to recover what was never theirs to begin with. They take the loss, and they remain unchanged. That is where control begins. And once that control is established, something unexpected happens. The need to win starts to fade. Not because winning is unimportant, but because it is no longer tied to identity. It becomes just another outcome, neutral, temporary, irrelevant to self-worth. This removes a large amount of pressure from every decision. And without that pressure, execution becomes cleaner, not perfect, but consistent. The trader is no longer trying to prove anything. They are simply following a process that they have already accepted, including its losses. There is a quiet confidence in that. Not the kind that seeks validation, but the kind that does not need it. And from the outside, it does not look impressive. There are no dramatic recoveries, no aggressive trades, no emotional reactions, just a steady rhythm of decisions made without urgency. This is what most people overlook, because it does not feel like winning. It feels like doing nothing special. But over time, that is exactly what separates those who stay from those who leave. Not intelligence, not strategy, not effort. Stability. Most traders never notice the exact moment where things begin to go wrong. It does not start with a large loss or a clear mistake. It starts quietly, almost invisibly, in the way they interpret pressure. A trade is placed. At first, everything feels neutral. The entry makes sense. The risk is defined. There is no urgency. But as soon as price begins to move, even slightly against the position, a subtle shift begins inside the body. There is a tightening in the chest, a slight leaning forward. Attention narrows. The mind begins to search for reassurance. It scans the chart, not for information, but for relief. And if that relief is not found quickly, the discomfort begins to grow. This is where the illusion of control starts to break. The trader believes they are still following a plan, but the internal state has already changed. Decisions are no longer being made from a neutral place. They are being influenced by a need to reduce what is being felt. And that need is rarely recognized in real time. Instead, it disguises itself as logic. The exit feels justified. The adjustment feels necessary. The hesitation feels responsible. But underneath all of it, there is a single driver: discomfort. Most people never learn how to sit inside that experience without reacting to it. So they build habits around avoiding it. They exit early to feel safe. They skip trades to avoid uncertainty. They increase size to recover faster. Every action is an attempt to regulate emotion through the market. But the market is not designed to regulate anything. It simply reflects what is already there. This creates a cycle that is difficult to break, because each decision that is made from discomfort reinforces the same pattern. The trader begins to associate relief with action. And over time, as that association becomes automatic, they are no longer choosing how to respond. They are conditioned. This is why consistency feels out of reach for so many people. Not because they lack understanding, but because their responses are no longer conscious. They are driven by patterns that operate faster than thought. Breaking that pattern does not come from trying harder. It comes from slowing down enough to notice what is happening before the reaction takes over. That space, even if it is brief, is where change begins. At first, it feels unnatural. The impulse to act is strong. The body wants resolution. It wants the discomfort to end. But instead of immediately responding, the trader pauses. Not to find a better decision, but to observe the current state. What is being felt, where it is felt, how intense it is. There is no attempt to remove it, no attempt to fix it, just awareness. And in that awareness, something important happens. The experience begins to lose its urgency, not because it disappears, but because it is no longer being resisted. Resistance is what amplifies emotional response. When the trader stops fighting the feeling, the intensity begins to settle on its own. This is not a technique. It is a shift in relationship. The trader is no longer trying to control the outcome in order to feel better. They are allowing the internal experience to exist without interference. And from that place, decisions become clearer. Not perfect, not always correct, but no longer reactive. This is where emotional regulation actually begins. Not through control, but through non-reaction. And it changes the way loss is experienced. Instead of triggering a cascade of thoughts and impulses, loss becomes a contained event. It happens. It is acknowledged, and then it passes. There is no need to immediately recover. No need to prove anything, no urgency to correct it. Just a return to baseline. That return is what most traders never develop. They carry the previous trade into the next one. The frustration, the disappointment, the subtle need to fix what just happened. And that accumulation of emotional residue begins to distort decision-making over time. Each trade is no longer independent. It is influenced by everything that came before it. This is how small losses turn into larger ones. Not through the market, but through the inability to reset. Resetting is not something that happens automatically. It requires awareness. It requires the willingness to pause, to step back, to let the internal state settle before engaging again. Without that, the trader remains in a continuous loop of reaction. There is also another layer that often goes unnoticed: the need to feel competent. Many traders tie their sense of ability to the outcome of their trades. When they win, there is a sense of validation. When they lose, there is doubt. And that fluctuation creates instability. Because now, every trade carries more than just financial risk. It carries psychological weight. The trader is no longer just managing a position. They are managing how they see themselves. And that is too much pressure for any decision to hold. When identity is attached to outcome, objectivity disappears. The trader cannot see clearly because they are involved emotionally in what the result means. Detaching from that is not about thinking differently. It is about experiencing trading in a different way. The shift happens when the trader begins to see each trade as just one instance within a much larger process. Not as a reflection of skill, but as a single expression of probability. In that perspective, the importance of any individual outcome decreases. And with that, the emotional charge decreases as well. There is no longer a need to defend against loss or chase validation through wins. Both become neutral events within a structured process. This neutrality is what allows consistency to emerge, because now the trader is free to execute without internal conflict. There is no argument happening in the background, no second-guessing driven by fear or expectation, just a clear action based on predefined conditions. Over time, this creates a different kind of confidence, not the confidence that comes from winning, but the confidence that comes from stability. From knowing that regardless of what happens, the response will remain consistent, and that is what builds trust. Not trust in the market, but trust in oneself. The ability to act without being pulled in different directions by emotion. The ability to remain steady when outcomes vary. The ability to continue without needing reassurance. This is what defines a professional approach. It is not visible in a single trade. It is not measured by short-term results. It is something that becomes apparent over time through the absence of unnecessary behavior. There are fewer impulsive decisions, fewer emotional reactions, fewer attempts to control what cannot be controlled. What remains is simple, a process that is followed, a risk that is accepted, an outcome that is allowed, and a mind that stays relatively unchanged through all of it. That is the difference. There is a point in a trader's development where the external struggle begins to fade, but the internal one becomes more visible. At first, the focus was on charts, entries, and outcomes. Now it shifts towards something quieter but more demanding: the awareness of self. The trader starts to notice patterns that are not on the screen. The same hesitation appearing in similar conditions. The same urge to interfere just before a trade resolves. The same subtle tension that builds without any clear reason. Nothing dramatic, nothing obvious, just repetition. And in that repetition, there is information. Most people ignore it because it does not feel productive. It does not look like analysis. It does not resemble improvement in the traditional sense. But this is where the deeper work exists. Because what is being revealed is not a flaw in the system. It is a pattern in behavior. And behavior, unlike the market, can be understood. When the trader begins to observe these patterns without trying to immediately change them, a different kind of clarity starts to form. There is less judgment, less urgency to fix, more curiosity. Why does this reaction appear here and not elsewhere? Why does this feeling intensify under certain conditions? Why does the need to act increase when uncertainty rises? These questions do not have immediate answers, but they do not need to. The value is in the observation itself. Because through consistent awareness, the patterns begin to lose their automatic nature. They slow down. What once felt instant now has a slight delay, a moment where the trader can see what is about to happen before it fully takes over. And in that moment, there is an opportunity. Not to force a different action, but to allow the pattern to pass without being followed. This is subtle. It does not feel like control. It feels like restraint. And over time, that restraint becomes natural. The trader no longer feels the same level of urgency to act on every impulse. The need to interfere begins to fade, not because the impulses disappear, but because they are no longer convincing. They are recognized for what they are. Temporary signals, not instructions. This changes the experience of trading in a fundamental way. There is more space. Space between thought and action. Space between outcome and reaction. Space between what happens and how it is interpreted. And in that space, stability grows. The trader is no longer being pulled into every movement of the market. There is less attachment to individual trades, less concern about immediate results, more attention on maintaining a consistent internal state. This is where the process becomes sustainable. Because now, trading is no longer driven by emotional fluctuation. It is guided by structure and supported by awareness. The external actions remain simple, but the internal environment is different. Calmer, more neutral, less reactive. This does not mean there are no difficult days. There will still be periods of drawdown, moments where nothing seems to work, times where doubt begins to surface again. But the difference is in how those moments are handled. They are not resisted. There is no attempt to escape the experience or override it with forced confidence. The trader allows the discomfort to exist without attaching meaning to it. It is just part of the process. And because of that, it passes more quickly. There is no buildup, no accumulation of frustration, no escalation into impulsive behavior, just a steady continuation of execution, even when conditions are not favorable. This is what creates durability. The ability to continue without needing conditions to feel good. The ability to operate without relying on positive feedback. The ability to remain consistent even when results are temporarily negative. Most people never reach this point because they are still waiting for trading to feel comfortable. But comfort is not the goal. Stability is. And stability does not come from eliminating discomfort. It comes from no longer being controlled by it. As this becomes more established, something else begins to shift. The trader's sense of identity starts to detach from the activity itself. There is less need to define oneself through trading performance. Less attachment to being seen as successful or skilled. The role becomes quieter. Trading is no longer who they are. It is something they do. This removes a significant amount of pressure, because now there is no need to prove anything through results. No need to maintain an image. No need to protect a sense of self that is tied to performance. The trader is free to operate without that weight, and in that freedom, decisions become simpler. There is no internal negotiation, no conflict between what should be done and what feels comfortable, just a clear execution of what has already been decided in advance. This is what allows consistency to extend over longer periods of time, not because the trader has found certainty, but because they no longer depend on it. They have accepted that outcomes will vary, that losses will occur, that not every trade will make sense in hindsight, and none of that disrupts their process. This acceptance is not passive. It is active. It is reinforced through repeated experience, through showing up, executing, observing, and continuing without needing each moment to confirm anything. Over time, this creates a different relationship with the market. It is no longer seen as something to conquer or predict. It is simply an environment where decisions are made under uncertainty, and the trader's role is not to control that environment, but to remain stable within it. That perspective removes a lot of unnecessary complexity. There is no need to constantly search for better conditions. No need to chase improvement through endless adjustments. The focus becomes narrower. Execute clearly, manage risk consistently, maintain internal stability. Everything else becomes secondary, and in that simplicity, there is clarity. The trader knows what they are doing and why they are doing it, not based on recent results, but based on a process that has been accepted over time. This is what allows them to continue without hesitation, not because they are certain, but because they are prepared. Prepared for loss, prepared for uncertainty, prepared for the internal responses that come with both. And because of that preparation, there is less disruption when those things occur. They are expected. And what is expected does not create the same level of reaction. This is where the experience of trading becomes quieter, less dramatic, less emotional, less event-driven. There are no extreme highs or lows, just a steady engagement with the process. From the outside, it may look uneventful, but internally, it is structured. And that structure is what allows the trader to remain consistent over time, not through effort, but through alignment. At some point, the trader stops looking for a breakthrough, not because they have found one, but because they understand that nothing external is going to resolve what they feel internally. The search for a better system, a cleaner entry, a more reliable confirmation begins to lose its intensity. There is a quiet realization that the problem was never in the market. It was in the way they were meeting it. Before, every session carried a kind of expectation. Today could be different. Today could make up for yesterday. Today could confirm that they are improving. And without noticing it, that expectation created pressure. Pressure to perform. Pressure to recover. Pressure to validate effort. And under that pressure, even simple decisions became heavy. Now that pressure is no longer necessary. The trader sits down without needing anything from the session. There is no demand for a specific outcome, no attempt to extract a result that justifies their time. The focus is narrower. Follow the process. Manage the position. Remain stable. That is enough. And because it is enough, there is no urgency. Trades are taken when they appear, passed when they do not. There is no forcing, no searching, no sense that something must happen. The market can move without participation, and it does not create tension. This is where patience becomes natural, not as something that is practiced, but as something that remains when the need to act disappears. Most traders try to be patient while still wanting results. That creates conflict. The mind says wait, but the body wants resolution, and eventually the body wins. Here, that conflict is gone. There is nothing to wait for because there is nothing being chased. This changes the experience of time. The trader is no longer watching every movement with intensity. There is space between observations, space to step away, space to return without feeling like something was missed. And in that space, the nervous system stays regulated. Decisions are made from a consistent state, not from fluctuating emotion. There is no buildup of tension across trades. Each one begins from the same baseline. This is what allows execution to remain stable even after a series of losses. Because the losses are not accumulating psychologically, they are recorded, understood, and left where they belong. There is no story attached to them. No narrative about what they mean, no extension into the next decision. They exist as data, nothing more. And because of that, they do not interfere. The trader does not need to recover confidence, because confidence is no longer based on outcome. It is based on the ability to remain consistent. And that ability is not affected by a single result. This is where the relationship with profit also begins to change. Profit is no longer something that is pursued directly. It becomes a byproduct of consistent behavior over time. There is no attempt to accelerate it, no desire to maximize every opportunity, because the trader understands that trying to extract more from the market often leads to instability. So they take what is available within their process and leave the rest. There is restraint in that. Not forced restraint, but natural limitation. An understanding that doing less, but doing it consistently, produces a more stable outcome than trying to do more with intensity. This is difficult to accept in the beginning, because it feels like underperformance. It feels like leaving opportunity behind. It feels like not taking full advantage of what is possible. But over time, the results begin to reflect something different. Not dramatic growth, but steady accumulation. Not large swings, but controlled progression. And more importantly, the internal state remains unchanged throughout. There are no emotional spikes attached to profit, no sense of relief or excitement that alters behavior, just recognition that the process produced a favorable outcome in that instance. And then a return to baseline. This is what keeps the trader grounded. Because without that grounding, success can be just as destabilizing as loss. It can create overconfidence, it can reduce caution, it can lead to subtle changes in behavior that are not immediately noticed. Here, those shifts are less likely to occur, because the trader is not reacting to success any more than they react to failure. Both are part of the same process, and that process continues regardless of short-term variation. There is also a different kind of awareness that develops over time. The trader becomes more sensitive to internal changes. Small increases in tension, slight shifts in focus, early signs of fatigue or frustration. These signals are no longer ignored. They are observed and respected. If the state is not stable, the trader steps back, not as a rule, but as a natural response. There is no need to push through, no belief that more effort will produce a better result. Because experience has shown that decisions made from an unstable state tend to create unnecessary outcomes. So the work becomes less about doing more and more about doing only what can be done well. This is where efficiency appears, not in the number of trades, but in the quality of execution. Each decision is made with clarity. Each action is aligned with the process. There is no excess. And over time, that consistency compounds. Not just financially, but psychologically. The trader becomes more settled, more predictable in their behavior, less affected by external movement, more focused on maintaining a stable internal environment. This is what allows longevity, because the activity is no longer exhausting. It does not require constant emotional energy. It does not create cycles of stress and recovery. It exists within a controlled range of experience. And within that range, the trader can continue, day after day, session after session, without needing to reset completely, without needing to rebuild confidence, without needing to rediscover discipline. It is already there, not as something that is maintained through effort, but as something that has been developed through repetition and awareness. And at this stage, the idea of winning starts to feel different. It is no longer tied to a single trade, or a single day, or even a single month. Winning becomes the ability to remain consistent over time, to continue executing without disruption, to experience loss without escalation, to experience profit without attachment, to stay stable regardless of what the market presents. That is what most people are actually trying to achieve, even if they describe it differently. And it is only reached when the focus shifts away from outcomes and toward internal regulation. Because in the end, the market does not determine whether a trader succeeds. It only reveals whether they are stable enough to continue.